Bloomberg FX Masterclass, brought to you by FX Pro. Trade Forex like a pro.
Traders in foreign exchange will use fundamental and/or technical analysis to speculate about the direction of a country's currency. Seasonal patterns can also be used to predict FX price trends.
A seasonal pattern can be something that affects any market, not just currencies, because it has to do with potentially the economic patterns of a country, a particular industry, a country that's a huge agricultural exporter.
In equities, there's something called the January effect. It's when stocks perform better between the last day of December and the fifth trading day of January.
December tends to see the dollar weaken, and January tends to see the dollar strengthen. That's one seasonal pattern that we've observed over 30 years.
Although some traders warn against putting too much faith in seasonal patterns, research has shown that the U.S. dollar rose against the euro and the Swiss franc 9 out of the past 11 years, or 82% of the time in January.
If our crude oil demand increases at a certain time of year, for example in the spring for driving season, well, that potentially increases demand for gasoline. Canada is our largest importer of crude oil in the United States, so that could also artificially create a demand for that currency.
There are other seasonal patterns in countries that have a significant number of foreign workers living abroad who send earnings home to their families, and oftentimes they do that at the end of the year or around holiday time.
Seasonal analysis looks at shifts in supply and demand. Some factors to consider are a country's agricultural production, weather patterns, production cycles, and consumer demand. Thanks for watching Bloomberg FX Masterclass. I'm Carol Biaggi.
Bloomberg FX Masterclass, brought to you by FX Pro. Trade Forex like a pro.